Welcome back to Investing Talk Podcast. Today, we're zeroing in on a question we've seen popping up quite a bit. Is the Point Bridge America First ETF a good time to buy now? We're going to pull apart, all the important details, help you understand what makes this one unique, its track record, what might be coming down the pike. And hey, while we're getting started, please do hit that subscribe button, like this discussion if you find it helpful, and definitely leave us a comment. We really love hearing from you. And yeah, if there's a specific company or maybe another ETF you'd like us to look into next time, just let us know below. So this particular ETF, it really is fascinating, isn't it? I mean, on the surface, okay, it looks like maybe just another fund, but the methodology underneath, that really sets it apart. I'm genuinely curious to understand not just what companies are in it, but the philosophy, the why behind those choices.
That's exactly it. That's where the intrigue lies, I think. What's particularly striking here is that, well, this isn't just about your standard financial metrics, not at all. This analysis really forces us and you, the listener, to consider how political alignment can actually be an explicit rules-based investment strategy. It raises a really compelling question. How do personal values, maybe your values, and market performance, how do they actually intersect? Does that create some kind of unique opportunity? Or does it perhaps introduce a distinct, maybe less conventional set of risks?
Okay, let's unpack this then. What exactly is the Point Bridge America First ETF? What's its core mission, really? How are they defining America First in investment terms?
Right. So, at its heart, this ETF, it aims to track the performance of something called the Point Bridge America First Index. Now, its unique objective is to select and equally weight U.S.-listed companies. And this includes common stocks and also REITs, real estate investment trusts. The key is it picks companies whose employees and political action committees, their PACs, are highly supportive of Republican candidates and committees. So it's a very specific rules-based method that filters primarily for that political alignment.
Wow, okay, that's a strong statement right out of the gate. So the emphasis isn't just on financial health, balance sheets and all that, but also political leanings. How does the ETF actually manage to track this, well, somewhat unconventional index? Is it buying every single company that fits that description?
Not exactly. The ETF uses what's called a representative sampling strategy. It's trying to replicate the index exposure that way. So it selects a portfolio of stocks that, as a whole are designed to mirror the characteristics and the performance of the full index. It doesn't necessarily own every single constituent. And the companies it does select, the constituents, they're equally weighted every time it rebalances. The index itself gets reconstituted and rebalanced quarterly. And that equal weighting piece, it's quite important. It stops any single company from, dominating the portfolio too much, aims for a broader spread across its chosen names.
Okay. And when did this fund actually launch? Also, any structural details we should know about, maybe regarding risk?
Yeah, it's actually been around for a bit since September 6, 2017. Structurally, it's an open-end ETF. And the fund itself, it explicitly states it doesn't use leverage, doesn't use derivatives or commodity futures. Now, for you as an investor, that can be an important detail. It generally reduces certain types of risk, the kind that often come with more complex, highly structured investments. It keeps the underlying risk profile a bit simpler by avoiding those more speculative tools.
Right, okay. That gives us a pretty solid foundation on the how and why of its strategy now. The what? What kind of companies does this ETF actually hold right now? Can you give us a snapshot? Who are the top players in this politically aligned basket?
Absolutely. So looking at the most recent data, this was July 31st, 2025. The ETF holds 153 companies. Pretty decent number. And because of that equal weighting thing we just talked about, no single name really jumps out way above its index weight. If we kind of zoom in on the top 10 holdings, you'll see names like First Energy, NRG Energy, Darden Restaurants, Occidental Petroleum, Centerpoint Energy, Devon Energy, Las Vegas Sands, Exelon, Marathon Oil, and M&T Bank. What you might notice there is, a distinct leaning towards sectors like energy and utilities. Those often have pretty significant regulatory and governmental interactions, right?
Yeah, that's a surprisingly diverse mix of well-known names, actually. But like you said, definitely a noticeable tilt there. Does this unique selection process, this sort of political filter, does it lead to particular sector concentrations? What does the overall allocation look like?
Oh, it absolutely does. And this is really where that America First strategy, manifests itself in the portfolio construction. If we look at the bigger picture, the sector allocations as of July 31st, industrials make up a pretty big chunk, about 20%. Then you've got financial services around 15%, energy at 11.7%, utilities 10.7%, and consumer cyclical at 10.2%. What's really striking, though, is how small the technology sector is, just over 3%. That's a huge contrast to a lot of broad market indices. And another key point, all of its holdings are 100% U.S. equity, so it doesn't offer any international diversification. That's a choice, obviously, with its own implications for building a diversified portfolio.
Okay, so a very clear tilt towards certain, maybe more traditional, often heavily regulated parts of the economy.
Yeah.
Yeah, this is definitely not your typical tech-heavy growth fund, that's for sure. What about market capitalization? Are we talking mostly big household names, or is there more of a focus on smaller companies?
Yeah, that raises an important question for you, the investor. What kind of company size exposure are you actually getting here? The ETF is predominantly mid-cap. That makes up about 72.5% of the portfolio. There's also a significant chunk in large cap companies, nearly 22%. So while it does hold some larger, more established names, overall, it generally exhibits what we call a factor style tilt towards mid-cap value. For those maybe less familiar, that just means it intentionally leans into companies that are, moderately sized, not the mega caps, not tiny startups, and are seen as maybe undervalued by the market based on certain financial metrics. This mix, mid-cap size and a value approach, it can have a really distinct impact on its risk and return profile compared to, say, just a broad market fund.
Okay, so we've got the unique political screen, the sector concentrations, the mid-cap value leaning. The big question then becomes, with all this specialization, how has it actually performed for investors since it started?
Right, the performance. Looking at its recent performance, again, as of July 31, 2025, its one-year total return at net asset value, that's NAV, the value of its assets minus liabilities was, well, pretty respectable at plus 10.4%. However, and this is important, if we zoom out a bit and connect this to the bigger picture, look over a longer horizon, the story gets a little more nuanced. For example, let's say you invested $10,000 5 years ago. In this ETF, it would have grown to $22,012. Now, put that against a couple of benchmarks, the S&P 500 total return USD, that same $10,000 would have grown to a more impressive $28,684 over the same period. But compared to a mid-cap value peer group, which is arguably a more direct comparison given its style, that group only grew to $18,219. So yes, it definitely outperformed its specific mid-cap value peer group, but it significantly lagged the broader market's frankly stellar run over those 5 years.
That's a pretty stark difference against the S&P 500, yeah. But outperforming its direct peer group?
Yeah.
Certainly noteworthy. Okay, this brings us to another really critical point for any investor. What about the cost? The cost of investing in this particular ETF. Does this unique strategy come with a premium price tag?
Always an important question, the cost. The net expense ratio, basically what you pay annually in fees, it stands at 0.72%. Just to put that in perspective, for every $10,000 you invest, you're paying about $72 a year in fees. For income folks, it generally offers quarterly distributions. Historically, the yields have typically ranged from about 1.4% to maybe 2% annually. So you really need to weigh that cost against the specialized exposure it offers, especially when you compare it to maybe more generalized, much cheaper market funds.
Right. And given its specialized nature, how easy is it to actually trade this ETF? Is it highly liquid? Can you buy and sell it easily without much friction or cost?
Yeah. Its average daily trading volume is typically quite modest, usually fluctuates somewhere between maybe 9,000 and 15,000 shares a day. The 30-day median bid-ask spread, that's the gap between the buy and sell price, is around 0.22%. Now, while 0.22% might sound small, it's actually, well, wider compared to some of the really big conventional ETFs out there. Those might have spreads of just a few cents or basis points. What this means for you, the investor, is that frequent trading could end up being more costly because of those wider spreads. It's generally more suitable, I'd say, for a buy and hold approach rather than active day-to-day trading.
Gotcha. So relatively higher cost, lower trading volume.
Okay.
Suggests it's not really a vehicle for quick in and out moves. Okay, given all this information, the unique strategy, the portfolio, the performance, what does the current market picture look like? And what factors might influence its performance going forward?
Sure. So as of September 4th, 2025, the recent price was about $52.68. That puts it within its 52-week range, which saw a high of $56.42 and a low down at $42.22. What's maybe encouraging for current holders, or potentially bullish, is that its price is currently trading above its 200-day simple moving average. That average sits at $50.91. Technical analysts often see that as a positive medium-term trend signal. Additionally, the 14-day relative strength index, the RSI, is at 58.7. That's comfortably in a neutral to maybe slightly bullish range. It suggests the ETF isn't really overbought or oversold right now, but maybe has some positive momentum.
Okay, so the technicals look positive, reasonably positive lately. What about recent events or news? Anything specific that shaped its path over the past few months?
Yeah, there have been a few notable things. Over the last 3 months, we had its quarterly index rebalancing back in July. As you'd expect, that led to some shifts in sector weights and actually brought in some modest positive net inflows, which is good to see. August was particularly strong. We saw really solid Q2 earnings reported from several of its major energy and utility holdings. That really helped stabilize the share price, kept it above $51.50, even when the broader market was a bit choppy. Also in August, something interesting happened. A Schedule 13G filing popped up that usually indicates a new passive institutional investor has taken a significant stake, over 5%. So that revealed a new player was involved, which stirred up some market chatter. Then more recently in September, we definitely observed intensified market discussion around, well, Republican election prospects that naturally drew more attention to this ETF's unique political angle, and its quarterly dividend distribution was finalized too.
Quite a busy few months then. Looking ahead now, what's on the horizon that investors should maybe keep an eye on? Any upcoming catalysts that could potentially move the needle for this ETF?
Absolutely. Looking at over the next 3 months, there are several potential catalysts to watch. Its next quarterly ETF rebalancing is scheduled for September 13th. That could, again, lead to some portfolio shifts and maybe some trading volume. Then major holdings will start reporting their Q3 earnings around September 20th. If those results are strong, particularly in energy and utilities again, that could provide another boost. There's also an anticipated institutional buy report expected around October 2nd. If that reveals more large players are accumulating shares, that could certainly generate interest. On the macro level, you've got the ongoing fall U.S. election cycle, obviously very relevant here, plus upcoming Federal Reserve meetings, CPI inflation data. All those things will likely impact broader market volatility, and this ETF won't be immune. Beyond the scheduled stuff, there are also some whispers, rumors circulating, potential hedge fund accumulation, maybe a possible tweak to the index methodology itself, perhaps changing how they screen for PAC affiliation, and even the potential for a one-off special dividend if the underlying company's earnings exceed forecasts significantly. Lots to watch.
Right. And this whole political theme, it naturally brings up a set of risks that are, well, pretty unique compared to other ETFs, right? What are the key risk factors an investor should really think about before considering this?
Yeah, that's a crucial point. It raises important questions about the specific vulnerabilities of this kind of specialized investment. First, you've got fund-specific risks. There's always tracking risk. The ETF's performance might drift away from its index for various reasons, like fees or sampling. Then there's concentration risk. Because of its equal weighting and that inherent sector bias we talked about, it ends up with significant overweights in areas like utilities and industrials. If those sectors hit a rough patch, the ETF will definitely feel it more acutely than a diversified fund. Liquidity, as we mentioned, is also a consideration. That lower trading volume means larger trades could potentially move the price more than you'd see with a really liquid ETF. And then, more broadly, you have market and segment risks, but they're amplified here by that significant political exposure. This means its results and maybe even investor flows in and out could be highly sensitive to the shifting political winds, U.S. election cycles, and any changes in corporate political activity or donations. These are, frankly, non-traditional risks that a purely financially focused ETF might not face to the same degree. They really need to be carefully weighed.
Okay, so after exploring all of this, the unique strategy, the performance, the costs, the risks, what's the bottom line for someone asking that initial question? Is the PointBridge America First ETF a good time to buy now?
Well, our overall assessment, at least for most investors, rates this ETF probably a 4 out of 10. Look, while it certainly offers a unique rules-based way to get exposure to U.S. mid-cap companies that are supportive of Republican causes, essentially giving you a mid-cap value tilt with high sector concentration, it definitely comes with significant trade-offs. That 0.72% expense ratio, it's quite high compared to standard core U.S. equity or even typical value ETFs. And its trading liquidity is just modest, with those wider bid-ask spreads potentially penalizing frequent trading.
A 4 out of 10, that's a pretty strong and candid statement. How does it really stack up against more conventional alternatives, especially for someone just looking for general mid-cap value exposure, maybe without the political overlay?
Yeah, to put it in perspective, if you compare it to mainstream U.S. mid-cap value ETFs, think like the Vanguard mid-cap value ETF or the iShares Morningstar mid-cap value ETF, the cost difference is really significant. For instance, that Vanguard fund I mentioned, VOE, its expense ratio is just 0.07%. Compare that to this ETF's 0.72%. That's a massive difference that compounds and eats into your returns over the long haul. Plus, these more traditional peers, they offer vastly better liquidity, much higher trading volumes, and much tighter bid-ask spreads. Generally, they're far more cost-efficient if your main goal is just broad mid-cap value exposure.
Okay, so it's clear it's not really playing in the same league as those broad, low-cost options. For whom, then, might this ETF actually be a reasonable fit? If not as a core holding, who is its target audience?
That really gets to the heart of its intended use, I think. It's best considered as a long-term, maybe satellite position within a much broader, well-diversified portfolio. A smaller piece, it caters very specifically to politically motivated investors, those who are actively seeking a rules-based method of selecting stocks that are explicitly tied to Republican political activity. However, it is, I'd say unequivocally, not suitable as a core, low-cost U.S. equity allocation for most people. Its political thematic focus introduces that non-traditional layer of risk, political risk, concentration risk that you, as an investor, must carefully weigh against your overall portfolio strategy, your risk tolerance, and your personal values. It's an investment that clearly aligns with very specific values, but it comes at a higher cost and with distinct specialized risks that really warrant extra scrutiny.
That was a really insightful and thorough look at the PointBridge America First ETF. Yeah, it's crystal clear that while it offers a very distinct approach, you really, really need to understand its unique political strategy, how it's performed relative to different benchmarks, and definitely factor in those higher costs and the liquidity considerations before making any decisions. Certainly not for everyone, that seems obvious, but maybe for a specific type of investor with very clear objectives, perhaps it could align with their broader goals.
Indeed. And, beyond just the numbers and the strategy for this one fund, this analysis really highlights the increasing diversity, maybe even fragmentation, of investment products available today. It prompts us and you to consider a pretty fundamental question as we build our portfolios. How much are you actually willing to pay in terms of higher fees, maybe potentially diluted financial performance sometimes, for an investment that aligns directly with your specific values or political convictions? Is that alignment itself a form of personal return for you? Or does it introduce an unnecessary layer of risk, perhaps even emotional bias into your investing that might ultimately detract from achieving your long-term financial goals? It's something powerful to really ponder as you navigate the markets and build your own well-informed portfolio.
Absolutely. A lot to think about there. Thank you for joining us for this really in-depth discussion today. We certainly hope you found it valuable. Remember, again, please subscribe, like this if you enjoyed it, and leave us that comment, especially if there's a company or ETF you want us to tackle next time. We'll be back soon with another exploration.